Hey traders, welcome to the Top Tier Outlook. We are wrapping up the week of April. We're not only winding down the month, but we're going into May, which means this Friday we've got non-farm payroll. We have got it called FOMC meeting, something like that. So that is what we've got coming up this week. So let's tackle the first thing that we're obviously going to deal with, and that's the FOMC meeting here. And what is it that we're expecting for the May 1 meeting? Absolutely nothing. Well, I shouldn't say that. We are not expecting any move on the rates. And you can see really easily with the Fed Fund futures what is, and obviously it's close to fully discounted as we could possibly expect, 97.5%. This is the hold column. So there's this measly 2.5% for a potential cut. Not going to happen. In fact, May is not expected to be a cut month, and it hasn't been at all for some time. Now, if we were looking back at Fed Fund futures in November, December, even October of last year, maybe even January for a brief amount of time, the early part of Q1 still had the expectation that the Fed would act in March, May, maybe June. And as we continue to go through the year, that expectation just keeps getting pushed further and further out. And accompanying that, sort of, if you want to call it a disappointment, we are seeing then the stock equities indices, right? The stock market now finding a little bit of chop. It's bullish chop for the most part, but it's still chop all the same, meaning we're not seeing the continued follow through to the upside. And even though we've moved lower, as we have, April is probably the most bearish month in many, many months, we're not seeing a downtrend organize either. So what we have is a lot of disappointment, a little bit of a readjustment, because we're not going to see lower rates likely until possibly, July is kind of a no. September is where the conversation is sort of happening, meaning the current 525 to 550 is being, as you can see here, out discounted by the 500 to 525. Any column where this column is taller is where the conversations may be happening about a cut. And you'll notice that doesn't happen until September. And really, as we get later and later for cuts, the total number of cuts we're likely to get becomes less and less. Again, another reason for the equity markets to be disappointed, but not necessarily to drop dramatically. We have to unwind some of the more optimistic expectations for the number of cuts and how soon they would start, to fewer and later. And that's never going to be bullish, but it doesn't mean it's bearish, right? So that's where we sit as we're motoring to non-farm. Now, much like, let's go to the hot zones for a moment here. So much like the PCE and the CPI and all the other economic events we have coming, here's a look at the economic week. We do have, of course, a couple things to, actually, let me jump on over to, let's see, there we go, to Forex Factory. And you'll see as we go through the week, we do have a couple events to make note of. Nothing really on Monday. We have nothing really major on Tuesday, but it's really Wednesday where everything comes to a head, and that's the ADP. So, of course, ADP is that first sort of early look at non-farm. Not that they're anything alike, but it sort of starts the psychology going. We got final manufacturing PMI, ISM manufacturing PMI, the jolts, and all of that in and of itself would probably be something to think about, except for, oh yeah, here we have FOMC statement and the presser. Now, again, not expecting any kind of change in rates. What can be gleaned from the statement and the press conference? Is the Federal Reserve still open to cutting rates? And how soon might that be? So that'll be the first step. The second step would be, well, whatever we thought we read in the FOMC statement, is that being backed up by Powell during the press conference? And that's really where we have the 1-2 punch, if you will, in terms of Wednesday. Now, once we hear from Powell, fast forward, the unemployment claims on Thursday, and then the big jobs number on Friday. Now, remember, there's a dual mandate that this central bank has, the FOMC. One, of course, is that inflation target. But two is, as you're getting to that inflation target, right? Make sure you don't kill employment. So this is still very much a miss, a quote unquote miss in jobs would be bullish. Because the more it looks like the Fed's delays are causing problems, that's still why we see negative data, disappointing data in terms of inflation and employment metrics create a little bit more bullishness in the equity markets, because it's just the equity saying, hey, if Powell and company are noting what's happening with the data, and the data looks like they're starting to slow the economy, that their lack of action is a problem, then we're going to rally in anticipation that Powell's going to have to buckle. He's going to have to cut sooner, right? And that's the game that's being played, which is why quote unquote missed or bad data is bullish. And that's why good data has been largely bearish, right? That's the way that game is played. So the economic calendar really in many ways holds the fate of the market. Now, what about the fate of the market? I don't want to be a drama queen here. All right, there's no crying in baseball and there's no drama in trading. What do we have? We have a market that was once in an uptrend, right? Now trading in a neutral or sideways trend. So yes, a lot of bearish candles made their way into the early part of April. We still have bearish candles as we start to move higher, but this is still, for the most part, a neutral market. Now you might say, but wait a minute, Rog, we're taking a look at this top tier structure. This doesn't look neutral anymore. It is, yes, admittedly, it is a fresh downtrend. Now we're still going through earnings. We're still going through a lot of the volatility. So we will keep a very close eye on whether we have any traction to the downside. But here's the thing, whether there was a trend there or not, the rules of the top tier tell us a couple really simple things. When we have red candles, all we can do is focus on the gold zone. So any gold zone is a zone in which I would consider some kind of long put. Now, here's where I really have to step back and ask everyone, how is it that you're choosing the symbols that you're trading? How is it that you're looking at what you want to buy in terms of calls or maybe shares or maybe futures contracts? And how is it you're looking at what you want to short? Right? And where? Now in chop, we can have a back and forth, but in a trend, it's really very much one-sided. Is the S&P any better? The S&P is trying to transition to a downtrend. So Monday will be the telltale candle as to whether or not the S&P, like the Nas, turns into a downtrend. What about the Dow? So these are on the verge of getting a little bit more decidedly bearish. The Dow was bearish, and this is what I mean about having a very fresh transition, especially during earnings season. So the Dow went bearish here for 3 sessions, and really it's the confirmation of 2 sequential magenta trend signals. So here, this is and then we lost it. I mean, it was a very brief period of time in a downtrend, and any new downtrend, any fresh trend, that goes for an uptrend as well. A fresh trend is fairly vulnerable and usually pretty volatile. So are you saying, Rog, we got to be bearish? No, what I'm saying is let's leave the indices alone. Let's remember that we don't have to trade the S&P. We don't have to trade the NASDAQ. We don't have to trade the Dow. We can trade other places in this environment. And that brings me to gold, and that brings me to copper, and that brings me to crude oil. Because the structure in gold is decidedly bullish. Same thing goes with copper. All right, the same thing goes with crude oil. It's pretty bullish. Not as bullish as these 2 metals, though. But it's pretty darn bullish, dominated by mostly support above the 200 propulsion. So as long as there's strength here, it's to nobody's surprise that GDX, XME, XLE are all looking more bullish than the indices that they belong to, that they trade within. So this is where what you trade is more important than how you trade it, right? What we're looking at, where we're looking for follow through to the upside is very different right now than looking at the NASDAQ maybe being a fresh downtrend, maybe the S&P embracing a downtrend. If you crack open the indices, what you're going to find is there's a lot of detail sort of under the hood, if you will. And this is what that would look like. Let me change this to a dark color. There we go. So this is what this would look like. And it's so important to remember that while, of course, the indices could have a far larger impact on overall risk appetite and overall risk aversion, gold is going to take the GDX where it's going to take it. Crude oil is going to take the XLE, XOP, OIH where it's going to take it. So those relative performers have about as good a shot as any to kind of be able to ignore the broader averages. And we have to remember that. Now, the other thing that's telling me that there's a little bit more uncertainty coming in is that as we finish out April, probably the most notable strength has been in utilities and in staples. And staples and in utilities, those two sectors are where we go. They're defensives. That's where typically the market starts to pay a lot more attention to those because they're more resilient. They're a great place to hide out in times of uncertainty. And that's where XLU and XLP are. But it's really interesting. And the last 5 days, the 5-day flows on those two sectors, utilities and staples, were not positive. So that tells me that as much as they've kind of risen to the top, it's really not a lot of flows into XLP and XLU, which is notable because that means that there's capital waiting to be deployed elsewhere, or there's capital still in other places. And so when you look at the flows and you say, okay, XLP and XLU are up near the top, they're in the top 6, it's not as if the dollars are going there. If the dollars aren't going there, there's not really size there either. So it's just a little bit of relative performance where they've just sort of risen to the top while some other things have passed them on the way down. And so I'd be very careful committing longer term to utilities and staples until those flows, at least a 5-day flow, goes positive. So keep in mind that. All right, so questions that are popping up here. Let me take a look at what we've got. All right. Bonds. Okay, let's go take a look at bonds. All right, so we can take a look at two bonds. We can take a look at the long bond and the 10-year. They're both in downtrends for two really simple reasons. One, the Federal Reserve is taking far longer than what was anticipated in October, November of last year to cut. The bond yields have to go down. The other thing the bond yields are going to reflect is bond traders saying, Jerome, you're taking too long. Your delay is a negative impact on the economy. So those are things that we would most definitely keep in mind. As far as the second part of that question, sorry, I got my window open here today. It's pretty nice evening here in South Florida. Although I don't know what's in bloom. All right. So let's talk about then the stagflation question. All right. So little techno babble, right? So stagflation is basically stagnant economy, a stagnant growth and higher inflation, hence stagflation. So stagnant growth, economic growth, which if we take a look at GDP and even advanced GDP, I'm not sure I would say that, but higher inflation, we could say by the Fed's own metric, it's not as low as they'd like. So I don't know that we have the metrics for stagflation. If we have persistent or low growth, meaning GDP, which we just got, let's jump on over there. Give me one moment. All right, so let's go to here we go. So we just had GDP numbers. And by the way, GDP is a funny little data point now because we have had sequential negative GDP quarters and the Federal Reserve basically blew it off, right? They basically blew it off. They really did. They've redefined what they consider a recession to be. They've redefined in many ways what the GDP is. So you can look at the advanced GDP and you can see the previous was 3.4, which was revised higher. Expectations were for 2.5. We got 1.6. So yeah, if you look at advanced GDP, there's a pretty good argument that this is a number that would perceivably be the beginning of something like stagflation. But here's the thing where I kind of try to ignore sort of these names, these nicknames that we give different economic cycles. No cycle is the same. And all really that matters from a macroeconomic standpoint is what is the Federal Reserve going to say and do? And that really comes to a head on Wednesday. So again, stagnant economic growth, we could say this is actually heading lower based on advanced GDP, higher inflation. I'm not seeing signs of higher inflation. I know. I'm not talking about the real world. I'm talking about the data the Fed is looking at. That would be PCE. That would be mostly PCE. And they're looking at it ticking up a little bit, but I wouldn't consider it high anymore relative to where it's been. So that's a tough one. So the other things that, I would say would be hallmarks that would get me thinking stagflation is supply shocks. I'm trying to think what else. We don't have expansionary monetary policy, right? That would be another hallmark of it. We could look, the cost of crude, copper, silver are going up, but we don't have disruptions in supply, which oftentimes can be what kicks us into the stagflation. I don't know that I'm seeing weak consumer or business spending, because remember that demand side is part of stagflation. I don't believe, trying to think of the recent data, I don't think we're seeing weaker business spending. I don't think we're seeing weaker consumer. So I don't see those demand side issues, but it never hurts to be aware of what those characteristics might be. But at the end of the day, it's not going to change the way I trade, Charles. Yeah, so these are things where I would kind of put them in the side of, this is what economists would talk about. Traders and investors just need to look at the trend and the price and the volume and the volatility. Because at the end of the day, most stagflation, recession, all those are very backwards looking metrics. And even, for example, recession, let's take the scariest one, right? By the time we get 2 quarters of sequential negative GDP growth, by the time we get to the third quarter, that's when we would say, oh, we have been in a recession. And I would say a large percentage of the time, by the time we get to that third quarter, to look back and call what we've been trading through, what was the economy, a recession, we're usually pulling back out of it. So that's the other issue I have with any kind of those nicknames, which is by the time we look back and say this is what we have, it's actually what we had, because they're so slow in terms of what we need to see. Again, quarter over quarter GDP. All right, so that is that. So in terms of bonds, bonds are in a downtrend. That's the long bond. Notes are in a downtrend. That's the 10-year. And we know why. I mean, yields have to start being realistic about fewer cuts this year, which is very much what's discounted into that December 18 meeting. 1, maybe 2 cuts, not 2 or 3, maybe 4, as was what was expected late 2023 or early 2024. All right, so let's take a look at how we're doing this morning, or I should say Asian morning, this evening here in the US. Pretty boring open, which is fine. We're trading just a little bit above the previous session close. There's nothing bearish about that, but clearly still without any real, early Asian session. We're not gonna make any big judgments after the market's been open for 18 minutes. But we are trading above the previous session close, not above the previous session high. We have a long way to go before we get neutral candles again. So this is still very much, at least from a chop perspective, this is bearish chop. All right, what else do we have here? NEE. XLU, NEE is the number 1 weighted stock. So if XLU is moving higher, yeah, nice call. I would stick, look, as long as you're staying nimble, I wouldn't have any issue with looking at the high concentration weighted stocks, NEE, SO, DUK within the XLU. So none of the indices are weighted in XLU. No. So XLU is not something that's weighted at all, really, in any significant way in any of the indices. No, which is why it's a defensive, right? The defensive aspect of it comes from the fact that it is not tethered to the S&P or the Dow or the NASDAQ. How much weight should we put on the yen and Bank of Japan? I haven't given it much weighting. I really haven't. Bank of Japan already made some larger moves this year in terms of rates, and nothing really came from that. So Clearly, a weaker yen as a carry currency, as a lending currency, would be bullish to equities. A stronger yen would be bearish. But I have to tell you, I haven't been paying that much attention to the Bank of Japan because most of the conversations happening around the FOMC. Doesn't hurt to keep an eye on it, but it hasn't been a long-term mover that I've noted. I think there are bigger factors affecting the U.S. market based on the U.S. central bank, but certainly not a bad idea to keep an eye on it. But when we have the FOMC this week, I don't think U.S. investors give a rip what's happening with the BOJ. So I would say no, not this week anyway. Do I think lowering rates like in 1995? Charles, do I think a lowering of rates like in 1995 to do it because we can instead will reduce? Sorry, Charles, could you rephrase? Stay big stock market. Are you asking that if they're going to cut, are we going to fall? So that's a question a lot of folks ask. Is it time to start dipping our toes in bonds? Not yet. Not yet. I would not want to buy a downtrend on the daily chart of bonds. If you go out to the weekly chart of bonds, maybe, but no, I'm not ready to make any moves on bonds. And I don't actually there's no data that when the Fed starts cutting rates, that the equities drop. Remember, the reason the Fed might start cutting rates is because the equities have dropped. But once the Federal Reserve starts to cut rates, that is largely bullish. Yi said the ABCD macro cycle chart. Yeah, we'll probably have to dive into that this week in the mastery. Yeah, that might not be a bad idea. Dive into the ABCD macro cycle chart. All right, gang. As always, thank you so much for being here for Top Tier Outlook. Charles, I think I answered the question. Sorry, I didn't quite follow, but it sounds like if the Fed cuts, could that be bearish? And if that's the question, no. But as we're waiting, there is definitely a lot of uncertainty. And people don't buy when they're uncertain, right? They do short, to your point. All right, my friends, be good to each other. I'll see you tomorrow for Charts and Coffee.